Good afternoon, everyone. Thanks for the intro. So I'm Danny SALMAN again, Senior Market Analyst of MULTIBANK Group, one of the world's largest and most regulated Forex and CFD brokers. We offer some of the best trading conditions from spreads as low as 2 cents on gold, zero point zero pips on Forex, and swap-free trading on over 20,000 CFD shares. We're also very pleased to be one of the very first global financial institutions to be granted the UAE's Securities and Commodities Authority ESCA license. And so today we'll be speaking about navigating volatility and new market realities. We'll be taking a closer look at the rise of the US dollar, the macro shocks, inflation data and its impact on rate direction, and finally, the dollar peak. And so, as you all may already know, we witnessed a historical rise with the dollar index touching a 2-decade high and increasing over 20% over the past year. And when looking at other major currency pairs like the euro dollar, we hit a 2-decade low, well below parity of 0.95. The British pound hit a 3-decade low of 1.03, and the USD yen hit a 3-decade high of approximately 150. And so let's take a look at 3 key drivers that have been fueling the dollar's strength. So first, it is a higher yielding currency. The US Federal Reserve has already increased interest rates by 300 basis points this year, so widening the gap between interest rate differentials when compared to other major central banks, like the ECB, for instance, have increased interest rates by 125 basis points, and the Bank of England by 200 basis points. And so capital and investments tend to flow into higher yielding currencies, and of course, increasing its attractiveness for foreign investment. And second, it is still the world's dominant international reserve currency. Over 80% of FX transactions are done in US dollar, and accounts for 40% of global trade. In addition, commodities like oil, copper are denominated in US dollars, so meaning that traders and investors should hold US dollars in order to trade these goods. And finally, its safe haven status and appeal. Now, despite fears of a global recession, the US is still somewhat insulated from the uncertainties arising worldwide, from the energy crisis and conflict in Europe to China's zero COVID policy. So again, fueling back capital into the safety of US assets. And so more likely than not, we will see the dollar remain strong moving forward into 2023. But before moving forward, let's take a quick look back to better understand how we arrived to today. And so since 2020, we've had 4 major macro shocks on the global economy. We had the pandemic, where we saw a global economic shutdown, monetary expansion, where we saw huge fiscal and stimulus packages worth trillions of dollars being pumped into the economy, and the post-pandemic supply, where we saw a shift in demand and a surge in demand, which led to supply chain disruptions worldwide, and finally the Russia-Ukraine war, which hit energy prices specifically for Europe, who are heavily dependent on Russia, accounting for 40% of its natural gas imports. And so these macro shocks enhanced uncertainty and strong inflationary pressures, which led to the intervention of central banks and the fastest rise in interest rates since the 1990s. And so when looking at US interest rates and inflation rates, we see a close relationship between the two. Now, we also haven't seen inflation this high since the 1970s. But what's interesting is that Whenever inflation rates got too hot or rose too quickly, we tend to see interest rates rise above inflation rates in order to bring it back down. And so with higher interest rates, you have a higher borrowing cost, which will encourage less spending and more saving, which will translate into a weaker demand and a weaker labor market and the possibility of dipping into a recession in order to achieve the Fed's inflation target rate. And so how long do these cycles usually last? This is quite interesting in my opinion. So when you look at different time periods from the 1980s, when the Fed increased interest rates 2 or more times, we see that the average duration is 20 months and the longest duration is 36 months. So clearly showing that there's usually a time lag between monetary policy changes and real-life impacts on the US economy. And if we look at the US economy's most recent jobs report data, it came in above expectation. We've added 263,000 jobs versus 250,000 jobs. And unemployment rates dropped to 3.5% below expectations. So still indicating that the US labor market is still strong. And when looking at inflation, both headline inflation and core came in above expectation at 8.2% and 6.6%. Now, despite seeing a drop in headline inflation from last month's reading, we did not see the same for core inflation, which suggests that inflation is more stickier and persistent than we think. And so I believe that the golden signal that all investors and traders should be looking for is the peak of the dollar. And that will happen once the Fed rates peak, which could happen sometime around mid to late 2023. And we could see interest rates between 5 to 6%. And now looking at the dollar index from a short to medium term outlook, there could be some temporary pullbacks and retreats, but the first resistance we have is the 115.3 level, and the second level resistance, I would say, range is between 118 to 120. And when we look at also the US markets and the benchmark index, the S&P 500, more specifically the correlation between the dollar index and the S&P 500, we have a 3-month correlation of minus 0.8, 6-month correlation of minus 0.95, and a year-to-date of minus 0.69. So we're starting to see a very strong negative relationship between the dollar index and the S&P 500, which indicates possibly that the markets haven't bottomed just yet. And when looking at important levels to watch, we have the 3,500 level, which is considered an important level because it is the 50% retracement level drawn from the peak of the uptrend down to the pandemic low. And so we could see prices forming some kind of base here, and we may see some consolidation and more short-term relief rallies. Now, in case the markets anticipate a recession and are anticipating a hard landing scenario, and markets do price that in, then the next level for the downside target will be the 38.2%, which stands at around 3,200. And so to conclude, to summarize everything, so we still haven't seen a US dollar peak, which will happen once Fed rates peak, and we still haven't seen a market bottom yet. So thank you everyone for coming to this presentation. I'll be at booth number 5, where we can have a more personalized discussion and we can talk about trading strategies, and more importantly, we offer some high-quality market research and data analytics for our clients to help them and guide them with their trading. Thank you, everyone.